Thank you, Stefan. So yes, I will elaborate a little bit on a box or an article, that, as it is called nowadays, that we have in the report that presents basically a numerical example where we, using our general equilibrium model, we trace forward rates in foreign countries and in Sweden as a different policy assumption compared to what we have in our main scenario. And in that box, we start out the presentation by discussing various causes that may be at play when it comes to these low forward rates and how they could reflect low policy expectations. And generally speaking, you could think of forward rates as being low either because policy expectations are genuinely low or because there are lower term premia that put downward pressure on these forward rates. So in terms of that, the two first arguments that you can see here, the possibility that there's a pricing in of a double dip and the assumption of a lower neutral policy rate, those two would be more linked to low policy expectations, whereas probably most people would think of quantitative easing programs and flight to quality as being factors that would relate more to low term premia. In terms of the possibility of having a double dip priced in, we also have an experiment or a scenario in the second chapter where we look at, as Stefan just explained, a weaker development abroad. And from that, if you believe in the quantifications that we present there, you would need a rather severe double dip if you want to get as low as these forward rates indicate when it comes to policy. You may believe it or not, but that appears to be a conclusion if you believe in our quantitative assessments there. The assumption of a neutral policy rate is usually, and I think this is in the flavor of new Keynesian models, thought of as being something that relates to expected potential growth in the future being lower. This may or may not be something that you think is likely for, say, the US or maybe the euro area, but for Sweden it looks, of course, less likely given the strong outlook that Stefan just presented for the Swedish economy, at least at the moment. The next two causes, quantitative easing and flight to quality, I think have really to be seen in a context or jointly to understand why this might be really important for term premia. And quantitative easing, of course, means that there's a lot of cash around. People are still avoiding risk in light of the crisis, and the dispersion among countries in terms of credit quality has increased enormously during the crisis. I mean, some countries having huge fiscal problems, others, like Sweden, happily, do much better. So, for example, countries then like Sweden might have been affected quite a lot by investments into long government bonds and things like this, which might have suppressed these term premia in the Swedish case. We try to be, we don't make any firm conclusions on these arguments, but it's clear from our scenario that we don't embark on the market path at the moment, but we have a more conservative forecast in our main scenario where we follow market expectations for a while, but then we deviate from it and we have a quicker tightening vis-à-vis these forward rates. But it's important to remember that even in our path, interest rates remain quite low. If you look at the end of 2013 for Sweden and also for other countries, rates are still low compared to what we have as historical averages for inflation and growth going back, say, 10 or 20 years. But there's a possibility that things will turn out differently than we believe, and the purpose then of this box is try to shed some constructive light on what that could mean. So let me just then go through just a few slides from that box. It's basically a two-step experiment, where in the first experiment we force this general equilibrium model that we use in this context, we force it to track these forward rate expectations rather than what we have in the main scenario. So that means that policy shifts from following this red dashed line to following the blue dashed line instead. That's the first step in this experiment. What that means in Sweden then is that the repo rate is also lowered. So the Swedish repo rate shifts from the red dashed line to the blue dashed line, and you can see that the lowering of the rate is about a half of the effect from the lowering of the rates internationally. In the second experiment, we not only impose the forward rates for foreign countries, but also the forward rates for Sweden. So in that case, the assumption in the model is that the yellow dashed line is the policy that is followed in Sweden. And in terms of the effects, I will just show you the effects on inflation here. You can, in the box, you get effects on unemployment and other things. But you could see that then if the forward rates are applied to foreign countries, then the shift in Swedish policy is not enough to fully compensate for the inflation decline that we get in that case. So the blue line is below the red line in that experiment. Whereas if we also force onto the model the forward rates in Sweden, we get inflation that is too high vis-à-vis the target. So inflation will end up around 2.5% compared to our 2% target at the end of the forecasting horizon. Of course, this is an experiment based on a model. You always have to be careful with those things, but we try at least to shed some sort of light on this issue, and it is an issue that has been, I think we discussed this with you last time as well. And at the moment, I think, as I said before, our assumption for Sweden and for foreign countries is that we will follow these forward rates basically for a year or so, and then we will deviate from them and have a tighter policy than is indicated by the forward rates. But you can see from this picture that our assumption does not appear to be very odd vis-à-vis other forecasts that are available for Sweden at the moment. So here you have a couple of banks and also the National Institute of Economic Research and others in the picture, and you can see that our assumption seems to be quite well in line with that assumption of others.
So then to summarize, Swedish economy is growing rapidly, and it's growing more rapidly than, let's say, in the US and in Europe, where the recovery appears to be more uncertain. Given that this is the way things are, this also implies that inflationary pressures will gradually build up in the Swedish economy, and that means that we need to raise the policy rate, which we did yesterday and are likely to continue doing. While at the same time, given now what appears to be going on in the rest of the world, we have adjusted downwards the repo rate path a bit, particularly towards the end of the horizon. So this is where we are. This is what we hope will do the trick when it comes to having a balanced economic developments in the Swedish economy, while at the same time the inflation rate will be fairly close to our target.